Do you think the FANG names as a group are overvalued and maybe not worth our money right now?
You know, I really struggle with the term overvalued. I think that they've had way more than their share of outperformance. But with valuation, you can argue a lot of different things. You can argue that valuing Amazon on a PE basis is totally ridiculous and it should be valued on future cash flow generation or EBITDA multiples. So I'm not sure about that. But what I am quite confident in is that they've had more than their share of outperformance. So there's a really terrific chart that I saw last week that just stuck in my head. And what it shows is that the top 5 stocks in the S&P 500, which we keep talking about over and over, that's the chart, great. They're at a point right now that exceeds where the top 5 stocks were in 2000 at the very peak. And so what I did was, there's something about this chart that just stuck in my head. And my presumption was that if we looked back to 01, we would see that the top 5 at that point were the really high flyers, the value clicks and the double clicks and the Siennas. But in fact, they weren't, right? They were in many ways equivalent to the top 5 today. That's what they were: Microsoft, GE, Cisco, Walmart, Intel. And in 2000, in 1999, in that time frame, you couldn't make a negative argument against these companies. You couldn't really call them overvalued. The same as we can't really call Facebook and Amazon and Apple and Microsoft overvalued today. And the same as I can't make a negative argument against their businesses. Yeah. But back then, they had outperformed. Just like today, the top 5 have outperformed.
Back then, Jenny, listen, it was different. I mean, I hate to say it, but I'm old enough to be it. I think I was the first person to report from the NASDAQ live, or at least one of, and I remember talking about companies like CMGI and ICGE, companies that don't exist anymore, of course. You know, people can knock the FANG stocks and the big tech and their market weight, and I've certainly been critical of my fear about how heavily weighted they are in these market ETFs, because if they go down, the opposite of what we're seeing right now is likely to occur. But if you just own an index fund, you can't complain, at least, because they're the donkey pulling the market cart.
That's right. You can't complain, but what I find is that the conversation that I've had repeatedly over particularly the last 3 months, but really over the last year and a half, is, have I missed out? Have I missed out? Have I missed out? And I think the reality is yeah, you've probably missed out on the top 5, maybe probably the top 10. But I don't think you've missed out on the market more broadly. I think what's dangerous about those top 5 getting so much weight is if any of them stumble, it pulls the whole market back. But you don't need to suffer with the whole market if you don't own those top 5. I really believe that there's a lot of value, and I don't mean value, investing value. I mean a lot of reward and value in the real world, not in a multiple world. But there's a lot of value in the other 495 companies out there. If you look at the Russell 3000 and the other 2,995 companies, there are great companies. They just haven't had.
They are, but they get ignored. They get ignored, Jenny, because you just buy index funds and you sort of don't even know what's in there. Very quickly, leave us with an idea. One of your best ideas right now, outside of FANG, Jenny, is what?
Okay, my best idea. This is my recent purchase, National Retail Properties. It's a triple net lease REIT company. I just bought it last week. And as the economy returns and as people start to get out, I think that this business will really thrive. It's been punished disproportionately throughout. They own things like convenience stores, gas stations, stuff like that. So it's a little conservative, but I think it should benefit.